Hey folks, if you have any questions, you're welcome to jump in. A minute or two left before session starts. Okay, time we're at 11 o'clock, so I'm going to get started. A couple of reminders before I get started. I don't know whether you got my email about the Bloomberg anywhere. So even if you're not in New York, you can get the equivalent. It's actually quite magical. You can convert your terminal to look like a Bloomberg. The only constraint is I think Bloomberg allows like only a handful of people to be on at a given time. So you might have to try at odd times before you can get on. And that's why I'm saying if you get on the Bloomberg, be efficient, get your stuff, get out, because there are people lined up probably trying to get on. But it is neat to have that alternative. The other is if you haven't picked a company yet, none of this stuff is even, it's all moot because you can't print a beta page until you picked a company. So if you haven't picked a company, keep nagging you, please do pick a company, enter the name in that Google shared spreadsheet because, we're starting to move into the mechanics of cost of capital, cash flows. It'd be nice to have a company to try that on. Any questions before we start? Okay. So we're going to start as always with our start of the class test. And today we're going to talk about betas. And if you were in my corporate finance class, some of this again should be familiar, but no harm again repeating this. So let's start with a very simple question. A lot of people, when they think about betas, think about regression betas. We take returns in the stock and regress them against returns in a market index. And they assume it's a fact, right? They say it's a beta, it has to be a number. But it's not, because you have choices to make. You have choices to make about how far back to go, what index to run it against. As an example, I took Petrobras, and this was from way back, and I ran two regressions. One is of the local listing against the Bovespa. So if you go to Bloomberg, look up the local listing, the beta you would get be the page on the left. And on the right, I ran a regression of Petrobras ADR versus the S&P 500, with the ADR is actually a Petrobras listing that's traded in the US, so the returns are dollar terms. I can run against. They're both regressions, but they give very different pictures of the company, right? One gives me a beta close to 2, the other gives me a beta 1.66. The beta against the Bovespa gives me an R squared of 69%. And the beta against the S&P 500 gives me an R squared of 21%. So here's my first question, and anybody can jump in and answer this. Which of these two regressions would you use? If you had to use a regression beta, which of these two regressions would you use and why? If I followed pure statistical first principles, what are we taught to do in statistics?
Well, the greater R squared.
The greater R squared, right? And that's a terrible piece of advice here. Why is my R squared so much higher when I run Petrobras against the Bovespa than against the S&P 500? It's because the regression is better? It's because Petrobras is a bigger part of the Bovespa. It's just a pure math issue, right? If I take Siemens and run it against the DAX, I'm always going to get a higher R squared than if I ran Siemens against a European index or a global index. R squareds are almost completely irrelevant in your choice. Don't go with the highest R squared because it's going to lead you to a local index where your company is a big part of the index. It doesn't measure risk in the company because Petrobras is owned not just by Brazilians owning the Bovespa, it's owned by institutional investors who have Petrobras as part of their portfolio. So it can't be R squared. So what should I use? Should I go with a higher beta? That's the conservative thing to do, right? It's always better to go with more conservative numbers. I've seen people do that as well. The bottom line is these are both crap. I won't torture you by making you pick. These are both terrible choices. And if you gave me enough time, I could give you a dozen other choices with different indices, different starting points, different ending points. I'm going to talk about why I don't use it. I don't think I've valued a company with a regression beta in almost 30 years. And one of the reasons is precisely this. Regression betas are not facts. They're not even estimates, they're opinions where I can make the number be whatever I want it to be if I have enough bias in the process. And I'll give away the game. I'm going to argue that instead of using a regression beta, those of you in my corporate finance class remember this, use a bottom-up beta. Sounds fancy, but in a bottom-up beta, anybody want to help me out? What am I supposed to do? What's a bottom-up beta as opposed to regression beta? Come on, you remember enough corporate finance to do this. What do I do in a bottom-up beta instead of trusting one regression?
Identify the companies in the same industry and just calculate the.
So you start with the business your company is in or businesses. You find other companies in the same business and you look up their regression betas, still regression betas, and then you average them out, right? So let's say you decide to go down that route as I'll push you down and you're trying to figure out what companies to use. And I'll give you a choice. You can use a small sample of companies just like yours, or a larger sample of companies that may have differences from yours. Which would you rather have to get that average beta? A small group, let's say 3 or 4 or 5 companies just like yours, or 30 companies which are in the same business but have differences from yours. I mean, it's a choice you're going to have to make, right? As you go to S&P Capital IQ, you can define your comparables very narrowly or broadly. And I'm asking you to make a choice. Which would you rather have? Small sample of like companies or larger sample of? What's the biggest argument for bottom-up betas? Why do we, I mean, it's unfair because I'm the one pushing it, but what do you think I'm going to use as my biggest argument for why bottom-up betas are better than regression betas? I'm going to argue they're more precise. You know why they're more precise? It's not because there's a financial reason, it's a statistical reason. It's the law of large numbers. And what does the law of large numbers require? At the risk of sounding facetious, they require large numbers. What I'm trying to say is when you try to find a bottom-up beta, don't get too caught up in finding companies just like yours with the same market cap, because you're going to end up with 3 companies rather than 30. And I'd rather end up with 30. I'm actually giving you an invitation to be sloppy. Be sloppy, get a lot of companies, let the law of large numbers work in your favor. And that'll mean that when you look at comparable companies, you have to define comparable fairly broadly. It could be, it doesn't have to be, it doesn't have to be the same country, it doesn't have to be the same size, it doesn't have to be even in the same sector if it's driving its revenues from the same business. So we'll talk about the mechanics of doing this, but today we're going to talk more about betas and alternatives. But this is one of the things that's going to come up is what is it about regression betas that's untrustworthy? And I'll give you my case. And then we'll talk about the alternatives. So let me take you back to where I left you off last Wednesday. We were talking about equity risk premiums. And if you remember, I gave you the choices, right? There's a historical risk premium, it's backward looking and static, or a dynamic premium, the implied premium. Now, ultimately, which premium you use will depend on which one works best, right? Ultimately, you want a premium that does a good job of predicting the future. So I have this really long paper in equity risk premiums where I talk about all the different approaches, surveys, historical, implied, average implied. And then at the end of the paper, I say, look, it's not a he said, she said, they said, because then people use whatever risk premiums they want. We want a risk premium that does a good job of predicting the future. And here's how I measure how good these risk premiums were at predicting the future. I took each measure of the risk premium, whether it's historical or implied or average implied, and then I looked at how highly correlated it was with the actual returns over the next 10 years. Do you see what I'm trying to do? If a risk premium is a good predictor of the future, it should be highly correlated with what you actually see in the market. So you want a high positive correlation when you pick an equity risk premium. So let me give you 4 choices. One is the current implied premium, which I get by looking at the market today. The second is some kind of averaged out implied premium, which says numbers jump around, so I'm going to take an average implied premium. The third is a historical premium, where I look at the past. And the fourth is to take the default spread you have on a BAA rated bond and just multiply by 2. It's a very mechanical way of doing it, but it's very simplistic. 4 different approaches. And I've looked at each one's correlation with returns next year, the next 5 years, the next, remember, you want a high positive number. Well, guess which one seems to win on almost every single dimension? It's the implied premium. Much as we mistrust what the market is doing, it turns out to be the best predictor, and which is the worst possible way to estimate equity risk premiums. You want a big positive correlation. What do you not want to see? A big negative correlation. The worst possible way to get equity risk premiums is to look backwards. If any of you worked in appraisal, you know how you were taught to do equity risk premiums, right? You pulled up that Duff and Phelps book, which is a historical risk premium book. You looked across and you said, there it is, 4.35%. If you look at the correlation, you can see why that's a terrible way to do it. It's not even a good, it's a negative predictor of equity risk premiums. I would rather take the default spread and multiply by 2 than use a Duff and Phelps equity risk premium because it does a better job. I know I'm trying to sell you really hard in this implied equity risk premium approach. I don't know whether it's working or not, but I'll tell you one other advantage it has. If you wanted to, you could actually compute an implied equity risk premium for any market you want. Remember that convoluted approach I got to use to come up with country risk premiums, where I did the default spread and I multiplied by a multiple. Hey, there's a shortcut I could have used. If you ask me what the equity risk premium is for India, rather than go through that approach, where I start with the US premium and build up, I could actually compute an implied premium for India. How would I do it? The same way I do it for the S&P 500. I would take the level of the index, which I should know. I would take the cash flows from last year, a little messier than in the US, but I could look at dividends. But the problem with Indian companies is many of them might hold back on dividends. So if I could compute potential dividends, I could do that for last year. Remember, if I take the Sensex, I'm doing this for 30 or 40 companies. It's not a big deal. At the level of the index, at the cash flows last year, I need expected growth. And here again, it's messier than in the S&P 500, where you have a dozen analysts predicting earnings next year and 2 years from now. But I could get that forecast. And then I could do exactly what I did with the S&P 500, solve for that discount rate that makes the present value of my cash flows equal to the level of the index. This was in 2007, September 2007. I took the Sensex then, a long time ago. I took the cash flows and I backed out from the index what that expected return was. And in 2007, that number was 11.18%. You're saying, what does that mean? In September of 2007, if you bought Indian stocks, I don't know what you hoped you would make or thought you would make. Given what you were paying for those stocks, you could make 11.18%. You subtract out the risk-free rate then, which was 6.76%. My implied equity risk premium for Indian equities was 4.42%. So you might wonder why I don't do this for every country. Right now, my biggest challenge is not the theory or the mechanics, it's getting the data. I feel comfortable with the S&P 500. I've worked with it long enough. I can get the forecast that I can do this. I'm not quite comfortable doing this with other countries. I can give you a number, but I don't have much faith in that number. That is changing as data gets richer. One day, I think I could do this for every country, in which case I could replace that default spread-based approach with this approach of doing implied premiums. But if you're looking at a company and you want to try this on your market, do so, but don't get too stuck on it. Don't spend weeks trying to come up with an implied equity risk premium for your market. It's not worth the effort. It's not your fault. The data is just not there. And in fact, what the other country I've done implied premiums for regularly is Brazil. And just to show you how dynamic these implied premiums are, the way I did this was I did the implied premium for the US and the implied premium for Brazil every September, going back almost 20 years. So you look at the start of this graph. Early in the graph, Brazil is very risky. The implied equity risk premium in Brazil is almost twice the implied equity risk premium in the US. That number gets narrow. In fact, by the time you get to 2010, that number is almost down to zero, the extra premium. And if you're from Brazil or you've been to Brazil, that was the time when Brazil was convinced that it made the jump into the developed market world. And then, of course, you got the last decade, and we discovered that there were risks in Brazil we didn't even think about, and that showed up as the car wash scandal and political turmoil, and the risk premiums have widened out again. The advantage of implied premiums is they're forward-looking and they're dynamic. They reflect what's going on, and that's a good thing. And you build that into your valuations. Okay. Any questions on those? Okay. Final table, and then we leave equity risk premiums behind. Oh, go ahead, Jamil, your question?
Yeah, I mean, being that they're so dynamic, and as the example of Brazil, it changes quite a bit. How are you confident in your evaluation going forward? I mean, you're evaluating something usually to hold long term, and if the risk premium keeps on changing, the value from year to year could change quite a bit, especially if you're evaluating.
You're saying the country risk premium is volatile. How do you know it's not going to change? There are two levels when you invest, right? One is you make a judgment about the market, and the other is you make a judgment about a company. So in 2010, if you asked me what I thought about the Brazilian equity market, I'd have shown you that risk premium. And I said, that looks low relative to the, so you can bring in that market level analysis and say that premium looks too low, which will affect how much money you put into Brazilian equities. And then there's a second level question, which is, given that you've decided to put less or more money into Brazilian equities, which Brazilian equities should I buy? For that second level analysis, you know what I'm going to do? I'm going to use the actual implied premium, even if it's low, because I've already brought it into my asset allocation decision. I don't want to end up double counting. So I have two levels. One is, do I think the equity risk premium is too low? So if I look at a country and the equity risk premium looks too high, then that means I should be investing more of my money into that country because markets have overjudged the risk. And then on the company level decision, I'll go back to the implied premium today because I want something that reflects what this company is being valued at given where the market is today. So think of the two parts of your portfolio process as separate, the asset allocation, and I would say the same thing about US equity risk premiums. If you think 4.72% is too low, you're telling me stocks are expensive, they're too high, you'd put less of your money into equities. But then if you ask me how much, where should I put that 40% I've decided to put in equities, then I'd go back to the 4.72% to value individual companies. So by keeping the processes separate, you're not mixing up your market views with your company views, because if you do that, then you get a mess. You don't know whether your company is cheap or expensive, you're making a market judgment. One final table, and then I'll let equity risk premiums kind of put to rest. At the start of every year, I download 45,000 publicly traded companies, and I actually take these companies and I break them into two groups. Developed market companies, emerging. You know how much flack I get when I do this? Because for whatever reason, people seem to take it personally when I put a country that they're in into the emerging market. No, we're not an emerging market. I say, look, I'm not here to pass judgment on you, but I have to draw the line somewhere. Right? So I draw this line, I put emerging market, developed market companies. And then I actually compute an implied cost of equity for each group. So in 2004, for instance, developed market companies were being priced to earn about 7.28%. But emerging market companies were being, so I'm doing an implied cost of equity for all emerging market companies, 10.55%. So the top of the graph, you see 7.28, 10.55, that difference, 3.27%, is what investors were charging as an extra premium for investing in emerging markets. Take a look at that last column across time. It goes down, there's a 2008 blip. But by 2012, that difference had gone to almost zero. What does that mean? Investors were pricing developed market equities and emerging market equities as if they were equally risky. And there were stories that explained it, right? They said, you know what, after 2008, there is no emerging and developed market. They've all become shades of gray. But the reality is emerging markets still had this residual risk that popped up in the last decade. You see the premiums start to creep back up. But again, this is an asset allocation question, which is if you believe that the premium you're earning on emerging markets collectively is too low, you take your money out of emerging markets and put them into developed markets. If you believe the premium is too high, you'd move it across. It is a tool that you can use as a portfolio manager to decide which markets you want to overinvest in and which markets you want to underinvest in. And implied premiums become that proxy. Instead of you looking at PE ratios or something broader, you're looking at something very specific. So we're going to put equity risk premiums to rest. Any questions at all about equity risk premiums? It is, I mean, I call it the one number. If you were going to give me one number to describe an equity market at any point in time, the number I would pick is the equity risk premium, because it kind of captures everything, right? How stocks are priced, what the growth rate is, what the risk-free rate is. So from that perspective, it's a critical number to bring into the process. But once you've got it, move on. I mean, this is not the number you want to spend 90% of your valuation on. Get it nailed down for your company and country, move on to the next step. No questions about equity risk premiums? Okay. Let's talk about relative risk measures, because let's see where we are. We have a risk-free rate in whatever currency you've chosen to do the analysis. We have an equity risk premium that reflects where your company operates. Now we're talking about how much relative risk is there. How risky is my company relative to the average risk company? And I was taught betas, I'm sure the same way you were taught betas in foundations. I was told to run a regression of returns in the stock against returns in the market index. And I was told the slope of the line is the beta. It's a horrifically bad way to explain betas because it makes beta into a statistical number and it leaves you completely out of control. I'm going to argue against regression betas in multiple dimensions. I'll argue that they're noisy, they're backward looking, they're subject to game playing, but rather than talk about the abstract, let me give you examples of regression betas and how they make my case for me. First, when you have a regression beta, it's a slope of a line. It's a statistical regression. There's a slope, but that slope comes with a standard error. Remember statistics, you're taught to put the standard error in brackets below. And when you run a beta on Bloomberg, not only do you get a beta for the company, you get a standard error on that beta. So in this example, for instance, I have a regression that I ran for GoPro. This was when GoPro was at its peak, growing fast. The beta I got was 1.604. We'll talk about the adjust beta in a minute. And the standard error of the beta is 0.50. Think about it. I've told you the beta for GoPro is roughly 1.6. Oh, by the way, the standard error on that beta is 0.50. You remember enough statistics to give me a range on the beta? If my beta estimate is 1.6 and my standard error is 0.5, with 95% confidence, give me the range on the beta. Sergio, you want to try? What's the significance of the 95%? Seem to come out of nowhere. Why did I pick 95%? Statistics, what is 95%?
I mean, the majority of your values are going to fall within that range.
Two standard errors. That basically it is. 95% is two standard errors, right? What's my standard error here? 0.5. 2 times 0.5 is 1. So my true beta for GoPro could be anywhere from 0.6 to 2.6.
Not helpful.
That's going to good, right? It's like I could have thrown a number at a dartboard and got a better beta. It's a terrible beta. If I use this beta to value GoPro, I'm asking for trouble. You say, what if my beta looks really good? Then be very, very, very careful. Then it's even worse. You might have seen this page already in the corporate finance class, but this is my beta for Nokia that I ran in 2000. I've saved this beta page just to remind myself that just because a regression beta looks good doesn't make it trustworthy. This is a regression beta for Nokia in 2000. Go to Bloomberg, type in Nokia, beta page pops up. Kushal, help me out here. Why does my beta page look so good for Nokia? I mean, that's perfect, right? Every point is on the line. The R squared is like 93%. The standard error is close to 0. What is it about this regression that's making my beta look so good?
I'm going to guess the time period.
I could have picked any time period. My beta would have looked perfect here. Anybody else want to try? Why do you think my beta looks so good? Pablo?
They're taking all the outliers.
I'm not touching it. I'm just running the regression. I'm not removing it. So I'm not cheating it. That would be definitely cheating. I didn't do that. This is actual returns. Hakan?
Does Nokia make very large portion of the Finland stock market?
Take a look at the index. What does it say? The hex. When I ran this regression, I didn't even know there was an index called the hex. I thought it was a witch's curse until I ran the regression. You know what the hex stands for, right? The Helsinki exchange. You're saying, what the heck is Bloomberg going to Helsinki for? Bloomberg is very parochial. The way it computes betas is against a local index. You pick an Indian stock, it's always against Sensex. You pick a German stock, it's against the DAX. You pick a Finnish stock, it went to Finland. And there's a problem here. I didn't even know what was in the hex in 2000, so I decided to take a look. I wish I hadn't. In 2000, Nokia was 80% of the hex, 80%. So what do you have here? A regression of Nokia against Nokia. And what are we finding? The two move together. And what's the surprise here? And this is an almost useless beta, and here's why. You know who the largest investor in Nokia was in 2000? Was Barclays as part of the global index fund. And if you're Barclays saying, how risky is Nokia? You're not looking at the risk added to the hex, you're looking at the risk added to the MSCI. European stock betas will always look more precise than US stock betas because European indices tend to be 30 or 40 stocks. If you pick one of those stocks and regress them against the index, of course you're going to get a higher R squared. And it gets worse. Let me dig the grave and bury betas fully. I actually replaced this page on your beta page with something that, you know, I'd use Valiant, but most of you don't even remember Valiant. So I'll pick GameStop. Let me ask you a question. Do you think GameStop is a risky stock right now? I mean, it's moving all over the place. I went 20 to 400, back down to 40. I printed the beta page from Bloomberg last week. Take a look at the beta. It's minus. It's not even telling me Bloomberg that GameStop is not risky. It's saying GameStop will actually reduce the risk in your portfolio. And if I believe this regression, I deserve to lose money. You know why the beta is negative? What does beta measure? Somebody give me a working definition. Let's see if we get the definition now. Stephanie Leisner, what does beta measure?
The risk against the overall market.
I'm glad you added the overall. It doesn't measure risk. It measures how you move with the overall market. Now, do you see why GameStop's beta is negative? GameStop's moved a lot, but it had nothing to do with the market, right? It went from 20 to 400 on a couple of days when the market was actually down, went from 400 down to 50 in days the market was up. Betas measure how you move with the market. And because GameStop has had this incident, let's call it that, an aberration, something specific to the company causing it to move, its beta is actually going to drop towards zero and perhaps even become negative. Betas, when you run a regression beta, you're one slice of history, right? Basically, you're taking 2 years. If something happened during that slice that was unusual, an acquisition, a new CEO came in, it is going to affect your beta, even though it's not a forward-looking measure of risk. So not only are betas noisy, they're also going to become increasingly unreliable if you have an event happen to your company. And let's complete the process. And they're subject to gameplay. You saw the betas that I did for Petrobras against different indices. You give me enough time and access to a Bloomberg terminal, I can make your beta whatever you want it to be. You want a 1.2 beta? Give me enough time. I'll play with the index, play with this. Try this out. If you get some time on Bloomberg, play with the indices. Say, I want a beta 1.2. Can I get there? You're going to get there. It's a matter of playing game. Now, along the way, you probably noticed the adjusted beta, which sounds sophisticated, right? It sounds like Bloomberg is adjusting for something. Let me dispel that delusion. You know what the adjusted beta always is? It's a raw beta moved towards 1. That's all it is, with a constant formula. It's the same formula for every company. It is a completely and totally useless number. Because we know which direction is. You want to go from 1.4 to 1, you know how to get there. You don't need Bloomberg holding your hand and giving you the. So the bottom line is, if you can have access to a Bloomberg, you can print off the beta page, but you should take that beta page, drop it in the trash, because it is not what you want to build the valuation on. But unfortunately, that's the way most people in practice get betas. They get to Bloomberg, they look up the adjusted beta, or they look up the beta page, and they use that number acting as if it's a fact.
Professor,
You pause right there. Go ahead. Go ahead.
I have a quick question about GameStop or GameStop and its ability to kind of reduce risk within your portfolio. If the meme stocks have been found, I know it's not a lot of data, but to generally move in the opposite direction of the market. So like when there's a good day for the market, the meme stocks will go down and vice versa. Doesn't that in some sense, like
who by Ali, let me put you on the spot. Who are the people driving meme stock? Or give me a rough sense of age.
Probably like 20 to 30-year-old, mostly.
Predominantly male. It's 20 to
yeah.
30 per 20 to. How much? What do you think the attention span is of a 20 to 30-year-old male?
Attention span of humans is 8 seconds. So.
But this is going to be like 2 seconds. Do you see where I'm going? Today's meme stock is going to be tomorrow's forgotten stock. So if you could tell me that a stock is going to be a meme stock for the next 5 years, I'll go along with you. But right now, we don't know. That's going to be like a moving, right now they turn from, I mean, even in the 4 weeks we watched them, they've gone from GameStop to silver to Doge. I mean, it's amazing watching them jump around, and that's going to be the problem. Collectively, I agree with you. But the problem is, ahead of the fact, we don't even know what goes into that group. If we can somehow start to identify companies that are going to be in that group, then I'll go along with it that maybe this should be part of your portfolio. It'll be a low beta part of your portfolio because they'll tend to move in the opposite direction of the market. But the problem is putting stocks in that portfolio and leaving them there is going to be really difficult to do. Yeah, but you have a good point, which is if betas are driven by how you move with the market, these pricing factors, which we're looking at, could affect your beta. And by affecting your beta, they could actually play out in your hurdle rates, in your cost of capital as a company.
Thanks.
I have a question too.
Go ahead.
They only have a large effect as long as they kind of act together, right? As soon as they kind of disband, then they'll have less effect on the market.
Well, the point is, if you could tell me that a stock is going to be a favorite of this crowd for the next 5 years, and that they're going to do crazy things that cause the stock to go up and down that has nothing to do with the market, it's effectively like adding an investment to your portfolio that, if you look at it from a portfolio context, doesn't add much risk to your portfolio. So as long as you can assure me that it'll stay in that group, I'm not even talking about the group effect in your portfolio. I'm talking about what this, it'll be more like, adding, if you think about fantasy football as an investment, I don't think many of you do, but maybe some of you do. It's actually an investment that has a very low correlation with the rest of your market. It's not like your team wins when the market is up and the team loses. So it basically, so adding fantasy football as an investment to your portfolio is a low beta investment. The only problem is, can you deliver an expected return that beats that low beta? And that's going to be tough when DraftKings takes their 10% off the top or whatever they do. But a meme stock is more like fantasy football than a traditional company, because you've disconnected it from the economy and what the rest of the market is doing. Pablo? Your question, or your hand might be up from before?
Oh, sorry.
Yeah. Okay. So let's go back to betas. Betas evoke some very strong reactions. I remember being in Omaha. You know what happens in Omaha every year, right? That value investing Woodstock. I was there about 5 years ago talking to some value investors who come to Omaha year after year. And all I have to do to trigger this group is say the word beta. You get in front of a group of old-time value investors, you say the word beta, you're probably not going to make it out of that room alive. You've shut down the conversation, because when you say beta, their response is, oh, theories, we don't do betas here. And and Warren Buffett is famous for saying that he doesn't believe betas. Charlie Munger is even more caustic about betas. They said, we don't like betas. So I decided to put them on the spot. So I put up betas, and there's how many people in this room like betas? Not one hand went up. I said, okay. So tell me what it is about betas you don't like. And there are two broad critiques that came through. The first is they said, you know what, this notion of diversified investors and measuring, that makes no sense to us because the essence of value investing is you buy 4 or 5 stocks. You concentrate. So I said, okay, you don't like the diversified investor assumption. There's one half of the group said we don't. The other half said, no, that's not it. They said in intrinsic valuation, which is what we do, we don't trust markets, right? We started that presumption. And if you don't trust markets, why would you use a market price-based measure of risk when you care about fundamentals? And I said, fair enough. I said, you don't like betas, I'll give you alternatives. If your problem with betas is you don't like the diversified investor focus, here are your 3 choices. You can go with total standard deviation. Remember beta, I'm looking at only the portion of the variance that is explained by the market. Go with the total risk because you're saying, look, I care about all risk. You can convert that total risk into a ratio. So if your standard deviation as a stock is 40%, and the average for the entire market is 20%, 40 divided by 20 gives me a number that looks like a beta based on total risk. You could go with proxy models where you don't make assumptions about diversification. You know what a proxy model is? You look at the size of a company, you look at its price to book ratio, and you come up with a way of converting those into an expected return. That's what Pharma Fringe did, and we've added to that with more data. Or you can take a model like the CAPM and add factors to it to reflect the fact that you're not diversified. And many of you, if you worked in private company valuation, here's how they'll get a hurdle rate. They'll start with the risk-free rate plus beta times risk premium. And then they would add a small cap premium. And then they'll add what's called a company-specific risk premium, which most of the time they just make up. But basically their argument is, we're not diversified, so we're going to add 3% plus 5% plus 7% on to your CAPM. And I said, if you don't like the diversified risk, that's your choice. If you don't like the fact that we're using prices, tell me what you think is a better way of thinking about risk. And many of them said, that's easy, it's earnings. We don't care about prices, we care about earnings. I said, okay, so a company with more volatile earnings is riskier than a company with less volatile earnings, right? They said, that's it, that's exactly what we want to do. I said, okay, I can convert that into a number that looks like a beta. I can take every US company, compute the standard deviation in earnings for the last 10 years. In fact, I do this on my website. I compute the standard deviation in earnings. And then I can divide the standard deviation in earnings for your company by the average across the market. So let's say that your company's earnings have a standard deviation of 20%. And the market standard deviation, the average across all companies is 16%. 20 divided by 16 gives me 1.25. That number looks like a beta. If it's not earnings, you think default risk is the rock you want to fight on, I will convert your default. So my point is, betas are my way of coming up with hurdle rates. You don't like them, I would replace them with a number that you think better measures risk, whether it's earnings, even if it's a qualitative risk model where you say these companies, and many of them said, look, sectors, tech companies are risky, food processing companies are safe. I said, I don't agree with that, but I'll go along with it. My end game here is to come up with the cost of equity. I use betas, but you don't like betas. I'm willing to replace betas with whatever you think is a better alternative measure of risk. Too many people refuse to do discounted cash flow valuations because they don't like betas. In fact, out of that, this is a value investors forum, right? Every one of the people in that room describes himself as a value investor. And they said, and a question I asked them was a very direct one. When was the last time you actually valued a company? They said, yesterday I used a PE ratio, unexpected. I said, that's not valuation, that's pricing. When did you actually value a company? And this is, I think, the problem with old-time value investing. Most old-time value investors have never actually valued a company. They priced a company, they've used a PE ratio. And if you ask them why they haven't valued a company, they do this cockamamie, I don't like betas. Just stop. You don't like betas, use something else. A discounted cash flow valuation needs a discount rate. It doesn't say you have to believe the CAPM and market efficiency and modern portfolio theory to get there. So be ready for this argument, especially if you're an intrinsic value person, because a lot of people who claim to be believers in value out there, who when push comes to shove would refuse to do valuation and use betas as their excuse. Any questions on betas or alternatives to betas? So all I want is something that I can convert to a relative risk measure, whether it's a debt ratio, whether it's earnings variability, because that then stands in for my beta.
How does actually Buffett calculates the discount rate?
Does anybody know? Buffett is one of the most opaque value investors out there. I have never, in fact, I threw that out as a challenge on a Buffett sounding board, which is a terrible place to go because these are true believers. I said, can somebody send me an example of a valuation that Warren Buffett has actually done? I'm still waiting 7 years after I threw out that invitation. He's very opaque. He talks about doing valuation, but he doesn't actually tell you. The only time he was specific was about 20 years ago when he said he uses the risk-free rate as his discount rate. And remember that discussion we had at the start of the class, which is, why do you use a risk-free rate? He said, I take the earnings I can count on. It's like a certainty equivalent. So the bottom line is, I don't think I've ever seen a Buffett valuation of a company. And when he talks about valuation, he often talks, and you know what? You can get away with that kind of shortcut if you're working with mature companies with stable earnings, where you can do this hand waving. There's a reason why Buffett has never bought a tech company as a young tech company. Don't give me the Apple example. By the time he bought Apple, Apple was a grandfather by tech company age standards, right? There's a reason he's never, it's not just tech companies, he's never bought a growth company. That's the other challenge I throw out. Give me an example of a Buffett investment in a young growth company, whether it's a manufacturing company. And the reason is his approach to valuation is rigid. It works with very mature companies where the earnings are in a sense countable. And you could get away kind of saying, I don't care about risk, I'll use this 3% discount rate and everything. But you can't do that with an Airbnb, right? I mean, I don't care how smart you are. You can't just sit there, I'll use a 3% risk-free rate. You'll blow the valuation up. So the bottom line is, if you want to get out of that very narrow component of the market, which is mature companies with predictable earnings. And how many are left? They're probably a handful. And even among those companies, it can lead you to some very bad spots, right? Why did Buffett buy Kraft Heinz? Because he thought the earnings were predictable and he said, I'll settle for a low discount rate. And then he discovered that people weren't eating the 57 types of ketchup and the liquid cheese that stayed liquid for the rest of eternity. And then the whole next thing you know, the valuation blew up. It's a problem with getting old, right? I mean, if you define, I'll invest only in the things I understand, you're going to get to be investing in a smaller and smaller part of the world. I mean, I had to, during the Super Bowl, the mid-game show, I had to turn to my kids and say, who is this guy? I mean, I've never heard of him. And they said, Dad, you haven't heard of most people. So they take it as a given. But it's not I'm not passing judgment of the person. It's a reflection that my zone of expertise. So I have to be willing to learn if I want to keep investing. And if you don't learn, you're going to get into narrower and narrower parts of the market. And very quickly, you're going to get priced out of that section. Which brings me then back to betas. Right? So I don't like regression betas. I've given you the alternatives to betas, but I'm going to go back and talk about better ways of estimating betas. Ultimately, your beta as a company is driven by three choices you make. And this should be familiar. This is from corporate finance. You probably either took it in my class or some other classes. First, tell me what business you're in. The more cyclical your business and the more discretionary your products and services, the higher your beta. You know what I mean by discretionary? If your customers can live without your product, they can delay buying it, defer buying it, you should have a higher beta than if they cannot do that. So tell me what business you're in. Second, tell me something about your cost structure. The greater the proportion of your costs that are fixed costs, the higher your beta as a company. Let me repeat that again. No matter what business you're in, the greater the proportion of your costs that are fixed costs, the higher your beta as a company. Jesse, why is that? Why does having a lot of fixed costs? Give me the intuition as to why high fixed costs push up your beta. No? Anybody want to help Jesse out? What is it about high fixed costs that push up your beta?
Is it because of lower margins that you're actually?
Let's say we took two companies. They have the exact same margins, but one has all fixed costs and the other has all. What's the essence of fixed and variable? Variable cost is your revenues change, your costs change. Fixed cost is your revenues change, your costs stay pretty rigid. They both have the same margins to start the game. Why is the company with more fixed costs riskier than the one with more variable costs?
Probably the one with the fixed cost has more business risk associated with it.
In 2020, you have COVID, and you have two hospitality companies. One has a rigid cost structure. It owns hotels. It has costs of maintaining. The other has a more flexible good, which is they're an intermediary, Airbnb versus Marriott. You can see why Marriott is, in fact, Marriott's a bad example because they've sold off the real estate, but if you have a hotel company that owns the hotels, it's more risky because in bad times, you're going to lose a lot more money. In good times, you're going to make more. I'm not saying it's a worse investment. I'm just saying it's a riskier investment. Good times will get magnified. Bad times will get magnified. Holding all else constant, the more fixed cost you have as a business, the riskier you are. Something that companies have taken to heart. One of the things that companies have become much better at is making their cost structures more flexible, right? Because when you make your cost structures more flexible, you made yourself less risky. And sometimes, even if it means lower margins, you might come out ahead in terms of value because you have a more flexible cost structure. So what business are you in? What does your cost structure look like? There's a third and final factor, and this is self-inflicted. Because the first two, you might have no choice, right? You enter a business, in a sense, that business comes with a certain cost structure. It's very difficult to move it. The third factor is something you determine, which is how much am I borrowing? Why does it matter? When you borrow money, you create a fixed cost you did not have until you borrowed the money, which is interest expenses. You got to make it in good times. You got to make it in bad times. Your equity income is going to be much more volatile if you have debt than if you don't. Again, I'm not saying it's a bad thing. I'm just saying it does make your equity more risky. What we observe as a beta for your equity would reflect all three choices. What business are you in? How much do you have as fixed cost? How much have you borrowed? Intuitively, so nothing else really matters. Everything else you tell me about a company has to show up in one of those three places. It's a great way to clean up the discussion because somebody says, well, isn't a company with better management safer than a company with worse management? Not really. Because when you have better management, I raise my expectations of what you will make as revenues and margins. Risk comes from not being able to meet those expectations. It allows you to clean up the things that matter from the things that don't. So now let's take that to the next step and say, how do I use that insight to come up with the beta for a company? I'm going to take you through a three-step process to get a beta for a company. It's a little more elaborate than what I described in corporate finance, kind of hang in there. You come to me with a company, say, what's my beta? I'm going to try to come up with a beta for the business you're in based on whether it's discretionary or non-discretionary, whether it's cyclical or non-cyclical. That's the first step. Second step, to the degree that you control your operating, the fixed cost structure is called operating leverage. The degree that you make those choices, I'm going to try to control for operating leverage. Companies with high fixed costs should have higher betas than companies with low fixed costs. So I start with the business, adjust for operating leverage, and then adjust for financial leverage. In a perfect world, that's how I'd approach it. So I'll give you my bottom-up beta approach. And we'll talk about why I don't spend as much time, because that second step I'm going to gloss over, and I'll tell you why I'm going to gloss over it. To adjust for operating leverage, there are two things I need to know for a company. One is what portion of the costs are fixed, what are variable, right? I'll pose a challenge to you, and it's something I try anytime I look at a company's financials. When you look at a company's financials, whether it's Airbnb, Marriott, or Boeing, think about how costs are broken down. There's operating expenses, financial expenses, cost of goods sold, non-cost of goods sold. But it doesn't say fixed or variable. You got to guess. Now, you can base that guess on the data, right? You can see whether the number moves with revenues to see if it's fixed or variable. But the bottom line is, if I gave you the S&P Capital IQ data set, which you have access to, and you have a sector and you're saying, I want to see fixed and variable costs in this sector, getting the data is going to be really difficult. So when people ask me, why don't you control for operating leverage? Why do you give every steel company the same unlevered beta, the beta for the steel? No. It's because I really don't know what your fixed and variable costs are, and controlling for differences becomes a lot more problematic. Because if I can break down fixed and variable costs, I can do an operating leverage adjustment that looks just like my financial leverage adjustment. Remember, financial leverage, I use the debt to equity ratio. With operating leverage, I use fixed cost to variable costs. I get exactly the same kind of equation. So I'm kind of preempting the critique you will have is how come you're not adjusting for operating leverage? It's because in most cases, I don't have the information. It's an information problem, not a technique. We know how to control for operating leverage. We just don't have the information. And with financial leverage, we have a much better shot. Yeah, go ahead.
Yeah, now fixed cost and variable costs usually have a correlation with long-term debt and short-term debt. Can you use?
No, that's a separate issue. That's a financial leverage. This is operating leverage. So when we talk about,
Yes.
so it's true with debt, you can, yeah, go ahead.
To finance fixed costs, you usually take long-term debt.
No.
Nothing to do?
No. That will put you in serious trouble, right? Because if you don't have the revenues to cover so whether you borrow money or not depends on the stability of your revenues, not the stability of your costs. Now, how much you borrow, then whether you borrow long-term or short-term might depend upon, what the cost structure looks like. But your cost structure shouldn't be driving whether you borrow money or not. That should come from your revenues. So let's talk about adjusting for financial leverage. The traditional equation that you might have seen is called the Hamada equation. Developed in the early 1970s by Robert Hamada, taught at the University of Chicago. And to get a levered beta for a stock, here's what you do. You start with the unlevered beta of the business they're in. So think of this as the beta your stock would have had with no debt. You adjust for how much debt they have with a debt to equity ratio. And the debt and equity should be in market value terms. And to the extent that taxes buffer the impact of debt by making interest expenses tax deductible, you multiply the debt to equity. So this is a classic levered beta equation. This is what you saw in my corporate finance class. This is what you will see in most spreadsheets and most valuations. In some cases, people will ignore the 1 minus t, but it's a minor issue. But basically, your debt to equity ratio shows up as a higher levered beta. Now, there are a set of hidden assumptions in this equation that if people know their stuff, they can put you on the spot. This equation works if you assume that all of the operating risk in a company is borne by just the equity investors. Let me repeat that again. Your debt holders might have default risk, but that default risk can have nothing to do with operations. So basically, it's got to be almost uncorrelated with the rest of operating risk. The beta of debt has to be 0 for this equation to hold. Now you ask me, is the beta of debt 0? That's an empirical question, right? How do you decide whether the beta of debt is 0? What can I do to check it? I could look at the returns on your bonds against returns on a market index and see if the beta comes out to be 0, right? And if you're an investment grade company, the relationship between returns on your bond, the corporate bond, and the returns on the market turn out to be very low. The beta of 0 assumption works if you're AAA, AA, single A, maybe even triple B. I don't know how many of you in your prior lives worked with high yield, with distressed companies with high yield bonds. You know what tends to happen when you become distressed? Your high yield bonds start to behave like equity. Why? Because that's what people worry about. So what you start to get when you get to double B, single B, triple C is your bonds do carry a market risk. In other words, there's a beta for debt. And here again, people take their stand. They say, you know what? This equation you're using, the Hamada equation, is wrong because the beta of debt is not 0. Yeah, you're right. Therefore, I can't use levered betas. That's not true. If your problem with that Hamada beta is the beta of debt not being 0, here's the extended version of the equation where you bring in the beta of debt into your equation. In effect, intuitively, here's what you're doing. If your debt holders bear some of the risk in the company, as an equity investor, you just caught a break, right? Because instead of bearing all the risk, you passed it on to the debt holders. The beta of equity at very high debt ratios will actually be lower than what you've estimated with the traditional equation because you made the lenders take on some of the risk. You know how often I use that second equation? Never. You know why? Because I really don't care. Ultimately, your cost to capital is not going to change that much. But if you get one of these purists who get fixated on equations and formula, have this equation ready. If they pull out this, hey, beta of debt is non-zero, give them the job. Okay, I agree with you. Go estimate the beta of debt for me and bring it back. Now, then we'll use the beta of debt. You very quickly find them changing their mind about which equation they want to use because there's a lot more work that they created for themselves. But again, this is like the argument against betas. It's an argument people have because they don't want to adjust discount rates for risk. That's the bottom line. They want to use whatever they want to use. And you're just getting in the way. So can I adjust betas for the fact that debt? Yeah, just bring it in. So here's the approach to estimating betas. You start with the business or businesses, your companies, and I call it a bottom-up beta. I find as many publicly traded companies as I can in each of the businesses you're in. And they're publicly traded, so I can get a regression beta for each one. I get an average regression beta. So let's say you're in two businesses, steel and chemicals. I find 50 steel companies, 50 chemical companies. I take the average steel company beta, the average chemical company beta. That's a regression beta. A regression beta is an equity beta by definition. And it's affected by both the business these companies are in and how much debt they've chosen to have. So here's what I do. I take out the effect of debt from that average beta. It's an average debt to equity. It's called unlevering a beta, but what I'm doing is taking the regression beta, taking out the effect of debt. I end up with a unlevered beta for steel and an unlevered beta for chemicals. Then I come back to you and say, tell me how much value you get from each business. And you say 70% from steel, 30% from chemicals. I say, okay, I'll take a weighted average. That weighted average of the steel and chemical company unlevered betas becomes your company's unlevered beta. Then I ask you a final question. Do you have any debt? And if you say no, we're done. This is now the beta that I will use as the beta for your equity. And if you do have debt, I'm going to compute that debt to equity ratio. And remember that levered beta equation? I'd use that to come up with the levered beta. So let's go through the process. Think about your company while I do this. You start with a company. Some of your companies are single business companies. Your life got a lot simpler, right? If it's a single business company, you look up the regression betas of other companies in this business. You take the average regression beta. You get the debt and equity ratios and market value terms. You get an average debt to equity ratio. You unlever the beta. You now have an unlevered beta for your business. Then bring in the debt to equity ratio and you have a levered beta for your company. You're done. No multiple regressions to run, no deciding what indices to use. And what you have going for you is a very simple statistical backing, which is the average of 50 regression betas is going to be far more precise than any single regression beta. So even if in a single business, an average of 20 regression betas is going to be better than using one regression beta. So guess what I'm going to use if I had to value GameStop? I'm not going to use that regression beta. That would drive me crazy. I'm going to use the average beta of maybe retail companies. Or if they plan to be online retail and that's where the future is going to lie, maybe online retail companies. And I'm going to move on. I have far bigger fish to fry with GameStop than getting caught up in what the beta is. I mean, they have to survive. They got to make it through next year. They have to decide which stores to close. Those are the big decisions I'm going to be spending my time on, not finessing the beta by running 5 different regressions on it. It's more precise. It's more dynamic. If GameStop says we're going to stop retailing, traditional retailing, and becoming a gaming platform, I might give them a beta closer to a gaming platform beta than a retail beta. I get to choose the parameters. So if you change your story, you change your business, I will change your beta to reflect it. And guess what? If I came to you with an IPO, you're no longer stuck, right? Because in the traditional way, what do? You look up a regression beta. How do you do that for Airbnb in November of 2020 when they've not been public before? You now have a beta for any company. You can value a piece of a company, a business, a division, because you have a way of estimating betas for pretty much any business you have to value. Any questions on the bottom-up beta approach?
Yeah, Professor, quick question. I feel like in corporate finance, we used the median instead of the average. Is that right, or does it really matter?
Yeah, I'll tell you, that's a statistical question, right? If I gave you 20, if you have a small sample, what do you worry about the most? All you need is one outlier. With betas, you're probably not going to get a huge outlier, but with debt to equities, you can get a 5,000% for a company on the verge of disaster. So there is no one rule I would adopt, but if I have a smaller sample, I'm going to be more wary about using simple averages. I'd be using a median. If I have larger samples, things start to clean up by themselves. I don't have to worry as much. So that's the bottom line. The larger your sample, the less you have to worry about these statistical questions. And the smaller the sample, the challenge you face. So as a general rule, if you're going to be in a hurry to do this and you want to build it into an Excel spreadsheet, build in the median. That's why I report medians by sector, because I might not have the time to even think through this. I just want to use a number and move on. So medians are always safer than averages. Right? So that's why I use my medians in corporate finances to avoid those outlier issues. So nobody want to ask me the question, what if I have a company that's so unique I cannot find comparables? Some of you are thinking, right? I have a company that's so special. Nobody's ever done what this company has before. I'm going to talk about that because in a sense, the best way to kind of see bottom-up betas is to see them play out in companies. So remember the Vale example from corporate finance? If you weren't in my corporate finance class, not a big deal, but Vale is a Brazilian mining company. It's really a multinational mining company that happens to be incorporated in Brazil. So it's one of the companies we take through the corporate finance class. And I wanted to estimate a beta for Vale. And the way I estimate a beta for Vale is I broke them down into 4 businesses. And actually, it looks like I did a lot of work, but this is how Vale actually breaks its business itself down in its annual report. One is, of course, metals and mining. The second is iron ore, where they're the biggest iron ore mining company in the world. The third is fertilizers. They have a fertilizer division. And the fourth is they have a logistics business. And they gave me revenues by business. So the beta for Vale is going to be a weighted average of the betas of these 4 businesses. I went and found publicly traded companies in each business. The first thing to notice is I did not just use Brazilian companies. Why? Because the sample size is tiny. And Vale is a global mining company. So with each one, I looked at publicly traded companies in each business across the globe. So already you can see what that gives me, right? With the fertilizer business, for instance, look at how many companies I have, 693 companies around the world. What does that mean? I can afford to be incredibly sloppy in how I compute betas, and it's going to give me roughly the same number. With each of these businesses, I computed the unlevered beta by going through the process I just described. Take the regression beta, clean up for debt. And then I weighted them. And here's something we talked about in corporate finance. You can weight based on revenues, but then you're assuming that $1 in revenue in one business is the same as $1 in revenue in another business. And the reason that might not be true is margins vary across businesses. High margin businesses are worth more than low margin businesses. So here's what I did. Since I had these publicly traded companies in each business, I looked at what multiple of revenues companies sold at in this business by taking the market value of equity. It's called enterprise value, basically the combined value of each business. So typically a metal and mining company trades at about 1.97 times revenues. An iron ore company trades about 2.5 times revenues. I took what Vale reported as revenues in each business, multiplied by that enterprise value to sales. I get an estimated value of each business. Ultimately, my end game is to figure out what percentage of Vale's value comes from each business. And based on my judgments, Vale is about 76% iron ore. It's about 17% metals and mining. And then fertilizers and logistics are small pieces of the rest of the company. The weights all add up to 100%. Obviously, it's got to all add up. And my beta for Vale is a weighted average of the unlevered betas for those 4 businesses, weighted by that last column. Vale, in fact, after I did this, sold off their logistics business. Let's say you are the person in charge of valuing the logistics business for sale. Now I'm going to put you on the spot here. So you're the person valuing the logistics business for Vale. Which beta would you use in valuing the logistics business?
I will use the logistics beta.
Makes sense, right? Which is exactly. You know what though? When you see bankers valuing companies for sale, they'll often use the company's beta to value. And their defense is, we can't run a regression for the division. There's no past prices. You don't need that. As long as you can identify the business, you can look up betas by business. That's what you should be using when you value a particular slice of a company. So that's an advantage of using bottom-up betas, is you can now value pieces of a company. You can value acquisitions. Essentially, you've got a tool that's flexible enough to basically apply in any subset. Okay. In the last column there, actually, I compute the levered beta for Vale's divisions and the company, and I use a debt to equity ratio of like 55%. You see, where did that come from? That's actually a market debt divided by market equity for Vale as a company. I'm attaching the debt to equity ratio for all 5 divisions because Vale as a company borrows for all of them. And at least from my looking at the company, they all are capital intensive businesses that probably use a lot of debt. So I've made the assumption that the debt to equity is the same in all 4 divisions. And if you remember when we did this for Disney in the corporate finance class, I couldn't do that, right? Because the movie business and the theme park business are so different. I had to estimate a debt to equity for each one. But the mechanics of doing it are still break down the businesses, come up to the beta for a company. Any other questions on that calculation? Let's turn to Embraer. Embraer, yeah, go ahead.
I have a question. Going back to the sample size, you broke out Vale into different businesses, but for the sample size, would you have to do the same for them? So let's say a fertilizer company has their own, mining division. How does that work?
Perfect word, what you'd like are what are called pure plays. Pure plays are companies in only one business. 80% of global companies are in one business if you go past the big companies. One of the reasons I'm able to find more pure plays is I look across 45,000 publicly traded companies. If you look at just the S&P 500, it's going to be very difficult to get pure plays because every company is in 3 businesses, and who knows what the other 2 businesses are for some of these companies. So the advantage of bringing the whole market in is I get more pure plays. There are some companies that slip through that are not pure plays, but they get averaged out. The sample size is big enough. But you have a good point, which is, in a perfect world, you'd like companies that are just in fertilizers for the fertilizer beta. But it's very difficult to find pure plays, especially if you look at larger companies.
So, Professor, this is Manav again. So for example, in a healthcare sector, different countries in the world, the risk can be very different. Like, for example, in US it's less, but in China, I don't know, but it may be more. How do you bring that in?
What kind of risk are you worried about?
So the beta, sorry, how
No, but don't talk about betas yet. Tell me the basic operating risk part of a Chinese healthcare company versus a US healthcare company. What kind of risk are you worried about?
So, for example, the margins in China may be very different.
You're already
in the US.
I have to answer your question. So if your margins are different, build them into the margins. What does that have to do with beta? Right? So because you control both the cash flows and the denominator and the discount rate. A lot of risks we worry about are really cash flow risks, or things that we cause margins to be different, regulatory overlays different, revenue growth. I mean, let's face it, a Chinese or an Indian healthcare company has much higher potential growth than a US company, which already brings with it some risk characteristics, right? Because the economy is to be given. So if we want to talk about numbers that affect the numerator, let's leave them in the numerator because we can control what growth rates and margins we use for these different companies. If you're truly worried that regulatory risk is different, and maybe healthcare is one of these areas, telecom is the other, you can just focus on emerging market company betas. In fact, when you go to my website, I report global averages. I also report emerging market company averages. I actually report averages for China and India because they're big enough now that they can sustain themselves. So maybe the place to start, if you're looking at a Chinese healthcare company, start with the beta for Chinese healthcare companies. If you have 40 or 50 companies in your sample, you're already home. Might as well use that sample. So start narrow and expand. Okay, that's, I think, the best strategy. In fact, with Embraer, that's what I did. Brazilian aerospace company. Initially, I looked for other publicly traded Brazilian aerospace companies. You know how many I found? One, called Embraer. That doesn't help. So I said Latin American aerospace companies. You know how many I found? One, still Embraer. And then I said, why am I kind of looking at just Latin America? Embraer sells aircraft to European air. It actually competes with Bombardier and Boeing and Airbus in this larger market. So the Embraer, the way I got a beta was by looking at global aerospace companies. Now, is there country risk? Absolutely. You know where it's going to show up? When I do my equity risk premium. The beta is designed to capture business risk. And to that extent, I have no qualms about going global with companies and bringing in the betas. In the case of Embraer, the unlevered beta I used was the beta for aerospace companies, and the debt to equity ratio reflects that as well. So I keep the emerging market grouping separate. In fact, when I say, can I use global, that's what I look at. If you're in a business where there are big differences between developed and emerging markets, I will use the average for just emerging market companies. And there are 25,000 emerging market companies in my sample. I'm going to get a big enough sample that I can get away with the slicing. I just don't want to get to the country level, because then you really narrow your search. Right? If you look at just Polish companies, just Hungarian companies, just German companies. So let the sample size determine how broad you got to make your comparable, and keep expanding what comparable is till you get, and by enough, what am I talking about? Well, this in statistics, you know how the law of large numbers works, how much your standard error is going to get smaller as you get from 1 to 10 to 25 to 49. I'm deliberately picking those numbers. It's a square root of your sample size. If you have 10 companies, your standard error is going to be 1/3 my standard error. If you have 25, it's going to be 1/5. If you have 49, it's going to be 1/7. Would I love to have 100? Yes, but I'll take 49 over 25. I'll take 25 over 10, and I'll definitely take 10 over 1. Anything beats 1. Okay. So bring that in and you're going to be okay. Yeah. Oh, one final point in the case of Embraer, and this is something, especially if you worked in Europe or Latin America, you might have seen, is often when people talk about debt ratios, in Europe and Latin America, they tend to talk about net debt ratios. In the US, when people talk about debt ratios, you go to Yahoo Finance, they report gross debt ratios. You're saying, what the heck is gross and net? You know what the difference is? Gross debt, I take the total debt on your balance sheet. I compute the debt ratios based on the debt. Net debt, I net the cash out. Remember there's cash and marketable securities on your balance sheet? I net that out against the debt. That's your net debt ratio. You'd be surprised how many times I get emailed, every month on, hey, should I use gross or net? And my answer is just use one and be consistent. And let me explain. In the case of Embraer, the gross debt ratio, debt to equity ratio was almost 19%. That's what I used to get my levered beta. Its net debt to equity ratio in that year was minus 3.32%. You're saying, how can a debt ratio be negative? The cash exceeded the debt. Apple has a negative net debt ratio. This is not uncommon. If I decide to go the net debt to equity ratio route, I'll use the minus 3.32%. That's going to give me actually a levered beta for Embraer that's lower than my unlevered beta. It's okay. Don't second guess yourself. That lower levered beta is going to give me a lower cost of equity. So far, it looks like everything is coming up roses for Embraer, right? But then where do I use the cost of equity? To get a cost of capital. And to do a cost of capital, I need weights. Cost of equity times weight of equity plus cost of debt times weight of debt. And guess what? If I decide to use a net debt to equity to get a levered beta, I have to use a net debt ratio to come up with the cost of capital. And trust me on this one, I'll work through the numbers if you want, but my ending cost of capital for Embraer will be roughly the same if I use gross debt ratios all the way through or net debt ratios all the way through. But the key is to stay consistent once you've made a choice. Any questions about beta? So whatever company you're, can I put somebody on? Josh, what company are you doing?
Assuming you mean me, I'm doing a match.com or just match group, sorry.
Okay. Match, that's interesting. So what's your comparable firm list look like?
I'm expanding it to more, still in the works. Bumble is the big one, but looking at just other online services companies, which is pretty large.
But what business are they in? I know the
online dating.
matchmaking, but if you, there's never been a business called matchmaking, right? I mean, but it's a big, we know it's a big business because if you make a match, there's a wedding, and if there's a wedding, there's a lot of money spent. So one thing I might suggest you might want to do when you look at this business is looking at the broader business it feeds into, is the wedding business and the kinds of companies that might make money on that business. Because the problem with staying in the Match.com is most of the companies in this space that are public companies are young. Like Bumble's been around a few months, right? 2 months. You're not going to be able to get a regression beta or anything going for you. You might have to define business more broadly. And so I'm not pushing you in the wedding business direction, but you might want to look for companies in a broader business. Otherwise, you won't find enough companies. Any final questions on bottom-up betas before?
I just have a question. I
Yep.
know you hate this term, but could you define it as the networking effect? Because it depends on the user base, or that's too broad.
No, networking effect is as you get bigger, it gets easier to get bigger. That's my broad definition of a networking effect. So if your user base leads you to become more successful as the base becomes bigger, right? Like Uber has a networking effect. Why? Because if you're a driver, once you drive for a ride-sharing company, you go where the people already are, not for a startup. And if you're a customer who wants an app, you want to go with. So in the ride-sharing business, there's a tipping point where if you get to be a big enough ride-sharing company, you end up dominating, and it becomes very difficult for a startup. And technology has been full of networking effects, which is Google. And the tipping point will be when Google got big enough, Yahoo got wiped out. It wasn't like you could have two players. So what you're looking for in a business with networking benefits is as you get larger, is it getting more difficult for newcomers to come in? So eBay clearly has a networking benefit because you want to go where the other people are looking for things to buy. Not all technology companies have that advantage. The problem with streaming, where you don't have as much of a networking benefit, is I can stream multiple. So I have Disney, I have Netflix, I have Acorn. Don't ask me, I spend a lot of time watching TV. Like I have 5 different streams. Because they're not mutually exclusive, the networking effect is much smaller. So that's something to factor in when you see networking benefits, is because the tech guys, it's become this easy answer. Oh, we have networking benefits. What does that mean? No, they put them on the spot when they say networking benefits, because you're looking for that benefit of being able to grow easier as you get bigger.
Professor, for financial
yes.
service companies, a bank, how would unlever and
Don't. So that's actually a good point. Prachi brings up a point. If you have a bank, just use the levered beta of banks. You know why? Debt for a bank is not traditional debt. It's raw material. Defining the debt to equity ratio for a bank is a recipe for going insane. Right? You don't know where one stops. So banks, your life just got easier. You got levered beta, and then you get down on your knees and pray and hope that the regulatory framework that covers banks is actually working. Because when you use the same levered beta for all banks, what are you telling me? Roughly the same risk. And the reason we've historically been able to get away with that is we assume that if you're a really risky bank, the regulator is going to step in and stop you from doing stupid things because you're not supposed to be in existence in the first place. So the weaker the regulatory framework becomes, the more dangerous that assumption becomes. So later in this class, when we talk about banks, we'll talk about a way in which you can bring your regulatory capital into betas. So if you're undercapitalized, you have a higher beta. If you're overcapitalized, you might have a lower beta. Mm-hmm. But for the moment, just take the levered beta. Don't try to do a debt to equity unlevering, relevering. Oh. So let's do one final page, bringing everything we've talked about with the cost of equity into one place. So the risk-free rate you use has to be based on the currency you choose to do the analysis in. Cleaning up in some currencies, you can just use the government bond rate in others. Your beta reflects what business or businesses you're in. Your equity risk premium reflects where you do business. Every number in your cost of equity has a role, and it's a different role. Don't try to mix one role with the other. What I mean by that is I get people asking me, should I increase my beta for a company? It's a Bolivian company. It's a very risky company, or it's a very risky country. Should I use a higher beta? And I said, no, don't do that. Because you get a chance to use a higher equity risk premium. Your beta is supposed to measure how exposed you are on a business basis. Your equity risk premium is what you use to capture the country risk. I know we have just a couple of minutes, but let me lay the foundations for what we're going to do on Wednesday. All of this talk is to get a cost of equity. There's another component to capital, right, which is debt. So next session, when we start out, we're going to talk about how to come up with the cost of debt. Now, lay the foundational definition that's going to drive our search. The cost of debt is the rate at which your company can borrow money long-term today. Let me emphasize that again. It's the rate at which your company can borrow money long-term today. It's not the rate at which you borrowed money 2 years ago, 5 years ago, 10 years ago. It's rate. Which means to get a cost of debt, here's what I need. I need to start with the risk-free rate. No company should be able to borrow at less than the risk-free rate, or you've got a problem with that risk-free rate. And on top of that, I need to add a default spread or a credit spread. Think like when you think about cost of debt, think like a lender, think like a bank and say, what is the rate I would charge a company to borrow money from me? It's going to be risk-free rate plus default spread. So on Wednesday, when we start, we're going to talk about how to come up with a default spread, starting with the easy companies first. You know, the easy companies are going to be? They're companies that have bonds outstanding where you can look up the interest rate on the bond, or a rating on the company where somebody else has done the dirty work. But we're also going to talk about how to estimate the cost of debt for companies where you don't have a rating, you don't have bonds. And let's face it, 90% of companies globally have neither bonds nor ratings, but they have debt. You got to somehow figure out their costs of debt. So we're going to go down that path. And if you get a chance, if you have my corporate finance notes, you want to review the synthetic rating process, you're going to see an opening into how I'm going to try to estimate a cost of debt for companies where you don't have a rating. So I will wrap up with that, and I'll see you on Wednesday. Okay.
Thank you.
Take care. Bye-bye.